Yo, what's happening? I hope everybody is doing well on this Friday today. So, bringing you guys our weekly Q&A. Like we've got some good questions that have came in, and if there's anybody live, we'll take your questions then. But I've learned a lot this week. Despite being in the business for I haven't even been in the business that long. Almost 5 years. I learned a lot this week, and if I get to it, I'll share a couple of those things, and it just goes to show you that it never ceases to amaze me in this business. So, anyways, so if you got friends that are in this business, and they're not in our Facebook group, I would love for you to invite them and have them join the Facebook group. I mean, I think it would be awesome. Um, anyways, so let's get to the first question here. So the first question we got sent through this week was I've let's see, is that I've managed my own parks, but considering hiring a management company, what is everyone paying? Is it a percentage? What's all usually included in the price? Well, so this is interesting because, I recommend, kind of managing them yourself versus hiring it out. There are good companies out there. I know a couple of guys that do it and they probably do it well. Um, so, I mean, you need to find someone that's not going to kill you, like, but you also want to be able to like make it interesting for somebody. So I had a friend of mine, he owns like, I don't know, 200 or 300 spaces in Texas, and he was looking to hire a third party management company. And I warned him about, all the things that can go wrong with that. But he ended up working out a deal. I don't remember exactly what it was, but it was pretty incentive driven for the property management company. Because if you think about it, if you're only paying them 5 or 10% and you're trying to cheap it with a property management company, I mean, not much good is going to come out of that. Right. And what do I mean by that? Well, they're not going to have any money to hire anybody. Like if you have even 100 space park collecting $400 a month, yeah, you may have some extra money to pay there. But if you're only paying them 5% of that, that's 2 grand a month. Like who are they going to hire for 2 grand a month that's any good? Now, if the property management company has some scale in the area that you're looking at, maybe that could work, right? Because maybe they have someone that's already skilled, someone that's already talented, that where they could sort of you could become a part of their ecosystem, and that may work. So you could do that. But I would just make sure that they're incentivized correctly. If you have homes to sell, that they're getting something for that because they're handling the home sales and whatnot. And yeah, I would just make sure that they're getting something that incentivizes them to do it, right? And not just 5 or 10%, because that just doesn't get anybody that excited. I mean, I guess some people do it for that. We've had people ask us to manage their properties, but it's just not that lucrative. We would do it if you give us like some upside in the equity, because I just know what it takes to operate these things, and we've built out the systems and the processes to do it well, and that takes a lot of time. And to do that on 5 to 10%, um, why am I going to put more stress on my team to do that? Um, so yes, I guess to answer your question, sometimes it's a percentage, but I'm just warning you to like, incentivize the property management company to like take it seriously. Like if it's an easy tenant owned home project, sure, you could pay someone 10% and move on. But if there's more involved and it's a value add project and they're managing projects and stuff, like you're gonna have to pay them more to get somebody, halfway decent. It's not gonna screw up your investment. Um, I've just heard many, many horror stories, and then you ask like what all was included in the price. Well, that's negotiable. Um, but obviously, if they're managing it, you want to make sure that they take care of all those managerial duties. If you have a back office, there's stuff that they could take care of, but I would just be cautious. I would just be cautious and work out a deal with them that works. Um, but it's a great question, and I don't even know if I gave like a really straightforward answer to it, because I don't think there is a straightforward answer to this question. But I would just be cautious. I would just be cautious. The next question that we got. Let's see. Can you close your own purchases, or do you need an attorney? I know why you're asking this question. I know why you're asking this question. And I get it. I get it. When you're starting out, like, you don't want to pay for an attorney. But I always use an attorney on deals. Even if the seller's paying for title and they're checking title, I always want my attorney to look at that stuff. And especially if I'm like doing a deal with a bank, like, I want them to look at the loan docs because they've looked at them a bazillion times. Just so they know what to look out for. If there's any red flags in the loan docs, like, you don't want to screw around and end up signing something crazy that is going to hinder you in the future. So I would just be careful of that. I would always use an attorney. I mean, I mean, the only reason why you would be thinking about that is for, you're thinking about money, right? Which is all good, and we should be cognizant of how much that we spend. But I would just I would just get an attorney, dude. I'll get an attorney. Get an attorney. Um, I haven't really heard of any horror stories of people doing it without an attorney. I've never done it without an attorney, and I would always do it with an attorney. And it's not going to cost you that much if they're not doing title and you're not paying for title. Like, I mean, I don't know. It's like, I think the Orlando deal that we closed, we had an attorney look over our loan docs and kind of, help through the transaction. I think he charged us $1,000. I mean, my God, don't be cheap, and then end up missing something. Don't be like, you know, penny wise and pound foolish, especially in this business. What is a typical return on investment for MHPs? Well, I mean, there is no typical. I mean, it's all different, right? Like, there is no set standard, like, oh yeah, this is a typical return. It all depends on like what you're looking for and what your goals are. So I can tell you, us, like, at Victory Capital, our deals are typically doing an 18 to 23 to 25% IRR and a 2 to 2.5x equity multiple. So basically, an IRR is the average yearly return over those 5 years to a degree. There's different ways you can calculate IRR, but that counts the refinance. It doesn't mean we're necessarily going to make 25% in a year, but we'll pay cash flow throughout. Let's just say it's a 5-year deal. We'll pay cash flow through those 5 years. And then when we refinance or sell, all of that profit takes into account. And if you average that over the 5 years there, that would be, a 20 to 25% IRR. So, I mean, our deals just smoke anything you're going to get in the stock market, in your 401k, which you don't even know what it's invested in. But if you invest with like the big REITs or some of the big groups, they're buying, lower yield stuff that's nicer and a little easier to operate. We don't mind doing the hairy stuff because we're getting these big exits on them. So it's hard to say, like, typical ROI. If you're looking at buying your first deal, like, I don't even know, like, it just depends. Like, let's just say, for example, if you're working a 9 to 5 and you're like, hey, I just want some extra cash flow and I want it to be easy to operate. So you may buy something a little bit nicer. The going in cap rate is a little lower, but it's going to be less hands-on for you. It's not going to be very hands-on, right? And so you can get some extra cash flow. You're going to get more cash flow as you increase rents and decrease expenses if you manage it well. And on the it's going to increase in value because rents will inevitably go up. And that could be good for you, right? But again, it all depends on your goals. Like me personally, I'm still in capital multiplication mode. So I'm still trying to multiply capital, multiply capital, multiply capital, multiply capital. That I'm looking for something with a little bit more hair on it that we can go in and, fill up vacancies, sell off park owned homes, and increase values fast. Now, I will say, or way below market rents. But I will say this: we bought a park that was a lower cap rate back in July. Maybe you've heard me talk about this before, but it was really like not much of a heavy lift. And I got to tell you, it's pretty enticing. Like, we love that park. We love that park because there's just not much to do there. And, it's less headache. And it just, it sort of sits there until somebody does something stupid, which will happen, by the way. It's relatively easy to operate. And, I was talking to Kevin Bupp last week, and he was talking about how they transitioned from doing the heavy value add stuff to like, the bigger institutional style stuff, or the bigger stuff that it's a little bit cleaner, it's a little bit newer. Um, I'm sure it's less headache, and we may transition to doing more of that as we've been looking at more of those deals. But it's got to be interesting. Like, I'm still in capital multiplication mode, and I would assume that most people listening to this are too. Like, you don't want to make 4% on 50 grand or something forever. You're trying to multiply. So if you're trying to multiply, you got to do some deals with some hair on it. So that's what I would say, because there's really no typical ROI on a deal, because it's going to depend on where you are too. I mean, you could be in the middle of nowhere and maybe get some higher cash flow, and that could be good for you, less appreciation, lower rent growth, or you could be in a higher growth area, a large MSA, and maybe get less cash flow, but you're going to get more bang on the exit. But I look for deals that are actually cash flow and you get the bang on the exit. And there's different ways that we look for that. And you guys that have listened to this and listened to my podcast, you know how we do deals. So I hope that makes sense. I mean, there's just, a couple of these questions. I mean, there's just not any set answer to any of them. Okay. So the next question that we got here, how much capital do I need to get started? Well, you can get started with nothing. I mean, like, you can get started with nothing. And it just, when you start with nothing, like, you can figure it out, right? But there's just more barriers mentally that you have to overcome, because you're like, what if I put this deal under contract and I have to send 30 grand in earnest money? And I don't have it, right? Well, then you have to go reach out to someone to get the earnest money, right? And work out some kind of deal to get the earnest money. Okay. So wait, you solve that problem. Okay. Here's another problem you're going to run into is that you're also going to run into you're going to have to get a lender. And then the lender is going to say, now you need a good faith deposit. Okay, I need another 10, 15, 20, 25, 30 grand. Okay, where are you going to get that? So you got to go hunt that down, right? And you can do that. People do this all the time. And then the bank's going to say, you don't have any assets, dude. Maybe you do. You don't have any assets. We can't count your home. Or maybe they probably do count your home, actually. You got to get someone to guarantee the loan with you. So, yeah, you can do that too. Like, people will do that. Like, I've helped people with that. So it is possible to do them with no money down. And then the next thing you're going to run into, if you're raising money, the investor's going to be like, well, how much skin do you have in the game? And you're going to be like, well, I don't have any money to put in. So yeah, at that point, maybe you could just roll your acquisition fee in or whatever. But again, I think my point is like, you can do it with no money. If you're trying to raise from investors and put together like a syndication yourself. But other than that, again, it depends on the deal. I mean, I got sent the deal yesterday. It was like 5 lots, few hundred grand. Maybe you could get some seller financing on that. Maybe you could get a low down payment. Maybe you could put 30, 60, 90 grand down. Bang, you got a park there. A buddy of mine, he bought his first park. It was a small park. He put 10 grand down, right? So that's doable. And you really don't need that much. But like, again, as I've said before, this was a huge mistake of mine. And once you get in and start buying these things, this will eventually be like you'll realize it. The You're missing deals like focusing on a low down payment or no money down. Like you're missing the good deals because you're looking for that because there's not many of those. And you have to really widen your horizons. So we're under contract on a deal right now, and by the way, the no money down deal is usually shit. Like it's a lot of work. Like one of the deals we're under contract with right now, well, I like one of the parks. The other one is just a mess, and this would be a deal that would be like, hey, this would be sort of like a no money down deal, right? Like, hey, I would take this if that. So yeah, anyways, like, it just depends on what you need and what you're trying to do. Like, but you may need some money to start. But again, as I said before, you don't have to. What are the most common issues that arise in mobile home parks? Well, in the beginning, depending on what kind of park you're going to buy, you're going to run into, your tenants. Surprisingly enough, you have tenants that don't want the park to be improved. They don't want the improvements to be done. They don't want the rents to go up. They don't want anything. They want the park to still be a shit box. It's okay. They're not going to be a good fit for you because we are trying to give a better quality of life to the tenants. And the people that don't like that are the ones that we don't want in there that's actually probably creating a poor quality of life for the tenants. That is one of our main purposes is that we want to create quality of life for the tenants. What do I mean by quality of life? Hey, if something needs fixed, we freaking fix it. We don't bullshit. We fix it. If they need someone to talk to, we have someone to answer the phone. And if they don't, they leave a message or shoot a text and we get back to them as soon as possible. We're giving like a better service to the tenants, right? And a lot of issues happen with that in the beginning because people don't like that, surprisingly enough. Um, Other issues you'll run into is infrastructure. I mean, you're buying some of these old value add parks. We've witnessed it and um, we've had this, but you're going to deal with infrastructure shit like septic, well, and even on city water and city sewer. I mean, most of these, like some of our parks in Tampa, they were developed in the 50s. Um, I mean, the pipes in these things are old, and the diameter of some of these, it's cast iron, it's all kinds of, it's a mix. It's PVC, it's a mix because they patched up stuff over the years. But you're going to run into infrastructure stuff. So that's why it's very important to do due diligence. And, you do your due diligence and you figure out what these infrastructure issues can be. What is the stuff that can come up and like throw a wrench in your business plan? And then you bring money for that. At least I do. I bring extra capital for that. So we can handle those things effectively. But that's a lot of things you're going to deal with is infrastructure. And then, like, when you're going in and turning around the park, whether you have to evict people or whatnot, you're going to deal with code enforcement or the health department because they're going to call. No one, like code enforcement and the health department, they do not show up unless someone calls, right? And so you're going to run into pissed off tenants and they're going to call. And then you're going to have code enforcement to deal with for something. And all I can say is when you're dealing with a government agency, communicate, 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 because mom and pop never did that. Mom and pop never communicated with them, so they get a bad taste in their mouth. And so you have to sort of rekindle this relationship with the municipalities that like, hey, you're here to clean this dump up. And they'll work with you. They'll work with you. Yeah, so that's really like, problems that arise. I mean, there's random stuff too. I mean, your contractor doesn't pull a permit, like, and then you got to deal with something else. But those are the main things. You're looking at tenant stuff, skeletons in the closet that you didn't catch in due diligence. Sometimes they're bigger, sometimes they're smaller because the seller tries to hide stuff, which is normal. And you just have to work around that. Here we had a question. What tax benefits are available for mobile home park investors? So, like, this is why I love this business so much because the tax benefits are extraordinary. So, typically, and don't quote me on this, this is just what I've read and seen, like on a multifamily property for your cost segregation studies and your bonus depreciation. So, I'm not an accountant. I'm not giving freaking, advice here. I'm just, telling you how I see the world here. Um, so the bonus depreciation we can take, we can usually get about 65 to 70% of the property value in bonus depreciation. Sometimes more. Multifamily, I know it's about half of that. Could be wrong. Anybody may correct me, but I know it's a lot less than what we can do. And now we can take, so let's say if we're buying $1 million property, just to make it, simple, you may only put 300 grand in the property to buy it and you get a bank loan on it. But that 700,000 is depreciation that we can take over an extended period of time. I think it's maybe 12 years or 15 years. I don't know. If Eden Markowitz is on here, he can tell you. He's the cost seg expert. Or you can accelerate that now. Now you can get 40% of that. So I don't know what's the math on that. If you took 700,000, let's see. Trying to do this here. 280 grand. So you put 300 grand to buy the deal down, you're going to get a tax write-off for 280 grand in year one. And we used to have 60, 80, and 100% bonus depreciation. And hopefully we get the tax bill passed and Trump's able to do something to get that back. So you would have gotten a K1 from your property that year that said you had a loss of, $280,000. So those are huge, huge, huge tax benefits that you get as a mobile home park investor. Now you have to be an active investor. If you invest passively in a syndication, you cannot take these losses against your ordinary income. You can only take those losses to if you have other rental property or other passive income. Again, your situation may be different. Your accountant may have a workaround for that. I don't know. So you'd have to talk to your accountant. But this is why real estate investors don't pay taxes, right? Because we can accelerate the depreciation and we get so many tax benefits, especially in mobile home parks, for that. And it is one reason why I love this asset class, but it's really a byproduct. I mean, I like the underlying fundamentals better, and I don't like giving. I like avoiding taxes legally, and I love that. I love that. So I hope that answers your question. Um, let's see. Um, How do I increase the profitability of a mobile home park? Well, okay. First one's easy. You can increase rents. That'll increase the profitability. You can decrease expenses, billing back for water and sewer. Anything else you can bill back for? You can bill back for trash. You can bill back for property taxes. In some cases, and how you do this will vary from state to state. But that's really how you can do that. Also, once you get scale, you can get your scaled efficiencies, and you may have one manager that operates 10 parks, so your management fee for that park will be lower. So it really comes with obviously income increases, decreasing expenses, and decreasing expenses, billing back for stuff. And if there's any ancillary things you have there, you can rent those out or whatnot. Converting park-owned homes to tenant-owned is always a way to increase revenue. Or you could keep the park-owned home income. Like, I was on a call with Chris Rood and his group the other night, and in some markets it may make sense to do that. But that's not my business model. I like the tenant-owned home model. You can bring in homes. You can bring in homes. Um, yeah, you can bring in homes. It's hard, but that's new revenue for you when you bring in new homes. So the cool thing about this business is, like, we were talking about this on the call, is like There's a lot of stuff that you can do with this business. Is pretty cool and pretty creative. Not like, unlike multifamily, and I don't mind multifamily. I'm not hating on it. I think mobile home parks are better by far. Multifamily, like, yeah, I can renovate the unit, but like in parks, like I can scrape one off and bring a new unit on. I can completely rehab the unit. I can bring on a tiny home. I can bring on an RV. Um, yeah, if you have vacant lots too, and you're capable, like you're able to bring RVs, yeah, bring RVs in. If you have lots for storage, like we have a park that has like a little space where people keep their boat trailers and stuff. So you can do that. Um, there's a lot of cool things that you can do in this business to increase revenue. You just got to make sure the zoning allows it and the city allows it. Some people just do it and ask for forgiveness later. Um, it's up to you. It's up to you. Okay, the next question we had. Um, let's see. Should I consider partnering with others to invest in mobile home parks? 1000%. 1000%. And this is why I'm telling you this. So in the beginning, I didn't really want to use like invest with partners. I wanted to own it all myself. Which is, look, like, it's a bit selfish, it actually constrained me from actually growing and expanding. And, like, yes, if you buy it yourself and figure that out, all the cash flow is yours. But would you rather own 100%? You've heard this question. Would you rather own 100% of a 300, a $500,000 park, or, 5% for on $100 million? Like, I don't, you get the point, right? So I think it's great to partner because you're not going to be good at everything. I'm not good at everything. And, I need people to complement my skills. There are things that I'm really, really good at. I'm really good at underwriting. I'm really good at going out and finding deals. I'm really good at bringing in investors and talking about our business model. I'm good at like creating the, kind of like the vision for where we want to go. And I'm good at leadership. But I'm not good at like building the back end systems. I'm not good at like, building out processes, which I've done. I'm just not great at. And it's just not my thing. And you got to find partners that'll complement you on that stuff. Like, my partner right now, he loves that stuff. We complement each other so well because he likes doing the stuff I don't like doing. So I think that's huge. If you want to get into this business, and we've partnered with people. So if anybody's open, anybody wants to partner, obviously we don't partner with everybody, but, we'd love to get you in our ecosystem. Um, so yeah, I think it's great. I think the short answer is, yeah, it's absolutely great to work with, partners and find partners. Hope that helps. Uh, what's a good exit strategy? Well, what I'll just give you an example of some exit strategies and tell you like what our exit strategy is right now. So typically, um, we buy parks in condensed periods of time in condensed areas, right? What I mean by that is like Central Florida. Let's just say that for example. Then we're going to go to the bank a year, 2 years, a year and a half, 2 years later, if we've been able to add enough value and say, hey, bank, now we have this portfolio of 500 lots, 1,000 lots. We want to do a refinance strategy where we're going to refinance all these at one time. And I guess it's not really an exit, but it is. We're going to refinance, give investors a lot, if not all their money back. And then we still own the deal moving forward. This is after they've stabilized them, or we could sell them in that. You'll probably sell at a 7 cap and refinance at a 6. So there's a little bit extra value there for you. But yeah, I mean, I think from an exit strategy, it really just depends on what you're looking for. Like some people buy these things and never refinance. They want to pay down the debt. So eventually they're just making, complete cash flow, indefinitely. That's not my business model. I want to keep refinancing and pulling money out so I can go scale and buy more. But again, like a good exit strategy really depends on what you want as an investor. Again, if you're just looking for cash flow and you think it's good to pay off the debt, which I'm not saying it's a bad thing, I don't prefer it. Because I think real estate is actually good debt. Um, but yeah, I just keep refinancing and eventually I'll sell. I'm not going to hold on to these things forever. I think I would say I don't know. People ask me if I'm buying hold. Well, it depends on that. Do I hold longer than 5 years? Yeah, well, I think we'll maybe hold longer than 5 years. We'll see. But I'm definitely going to sell them at one point. I mean, I think there's going to be some point in time where I'm like, okay, yeah, I'd want to sell this park for whatever reason. Um, but I think a good exit strategy is whatever fits your business model. Like whatever fits your business model. Maybe some of these value add parks that we have, like, it's a good kind of go in and sort of flip it if that works for you. If you get an offer, like, we just bought a park in Orlando back in October, and someone called our office and was like, "Hey, we want to buy the park," and I was like, "All right, cool. Here's the number." And if they took that, I would sell it, right? Because I know that's what the property, like, it should be worth that here when we finish all the conversions. I would take that now, probably, if they were really going to pay that. Then I could return capital and we could, take our win and move on pretty fast. I would like that. So it just depends. It's situational and depends on what you want. So look, if you have questions, I'd be happy to answer them and help you. If you need assistance on your mobile home park journey, shoot me a message and we'll see how we can help you. If you're looking to partner on a deal, we do that too. Depending on the circumstances and who you are, obviously we vet any operator that we partner with. Um, yeah, so you can reach out, invite your friends to the Mobile Home Park Investing Pros group. You can watch the MHP show on iTunes or YouTube, and check out our YouTube channel. We've got all these archived there and videos and reels. Like, go subscribe to the YouTube channel. Our goal is to get to or get our subscribers up. Like, we want to get our subscribers up on YouTube, so go check that out. Anyways, we will see you next week. Peace.